the South African motor industry has historically not had a measurement of how things are going in the industry. And of course, motor vehicle sales in South Africa is such a great proxy for the overall health of the economy that we felt that there was a gap in the market for us to develop a confidence indicator that actually showed what really was happening on dealer floors. Up until now, we've been relying solely on the monthly NAAMSA release of their sales numbers. But of course, those sales numbers are influenced by seasonal changes as well as other factors that don't necessarily accurately indicate what is actually happening in the vehicle sales market. We started the sales confidence indicator in September 2007, and it's now into its 16th quarter. So the great thing about that is we're now starting to develop a nice bit of history that starts to allow us to really confirm that the sales confidence indicator is an accurate measurement not only of the current activity and confidence, but also of future activity and confidence. Well, confidence levels amongst dealers for much of last year and the beginning of this year have been very strong. And of course, it's very closely aligned to the number of vehicles they're selling. And of course, we know that the sales numbers last year were very high and the beginning of this year were equally high. So it's not surprising that the recent research is showing that confidence levels have remained reasonably high. 6.1 out of 10, which is the current measurement, is a reasonably high measurement, and again, that coincides nicely with the level of sales. So there certainly is a high degree of confidence out there. If one looks forward to 3 months and to 6 months, it seems as though dealers are perhaps less confident than they were a year ago that the market is going to stay buoyant and going to improve. But nonetheless, there still remains a high degree of confidence out there. The strength of the market, particularly over the last 2 or 3 months, has taken, I think, many industry commentators by some surprise. Because, as you say, there are a number of other economic factors that should indicate that consumers are going to become a little bit more wary. But I think there are a number of reasons why the sales numbers are quite buoyant. And I think the most important one is probably because there's never been a better time to buy a new car. Interest rates are at a 30-year low, and combined with the fact that vehicle CPI, which is the inflation rate of vehicles, has remained negative or flat for the last 2 or 3 years. So that means that consumers who bought a car 3 or 4 years ago can now go into a dealership floor, replace that car, and at a fairly similar price to what he paid 3 or 4 years ago, and then combined with a 5 or 6% reduction in the interest rate, his overall installment is going to be probably lower. We've also noticed that there is a buy-down effect, so consumers are clearly buying cheaper cars, much lower models, and we've also noticed that the period that consumers are electing to finance their cars continues to go out. So again, if you're paying the same price, you're buying a cheaper car, you're paying 4 or 5% lower on your interest rates, and you're extending the period, it means that you actually are saving money by buying a new car. Bearing in mind that last year was a big year, if I recall now, the 2010 numbers were around 25% up on the 2009 numbers. Granted, 2009 was off a low base. But 2011 over 2010 currently is registering 18% increase, which is 3% more than what we had predicted would happen this year. And in all likelihood, that number could even grow if the current buoyancy in the market continues. The impact of the Japanese crisis can be felt primarily in the light commercial vehicle market, and more specifically in the Nissan and the Toyota ranges, because they were the 2 manufacturers that were hardest hit by the tsunami. And I think if you look at the numbers, you can see that prior to the tsunami, we were selling on average around 6,500 light commercial vehicles just in those 2 manufacturers alone. This number reduced by some 20 or 30% during the tsunami, and then we can see that it started to recover. From August this year, that number has started to go back towards the 6,500, and in fact, in September, that number climbed to 7,300. I think that the vehicle industry is having mixed fortunes. I think if you look at Asia, particularly in the Chinese environment and some of the other larger Asian economies, vehicle sales remain buoyant. In fact, they are off the page. And I think many of the manufacturers are really surviving because of those big numbers. If you look across the water at the USA market, pretty benign growth in the USA market. And if you look at Europe, that growth is in fact hugely negative. Of course, the BRIC countries are also experiencing good growth in their sales, particularly the likes of Brazil. And of course, South Africa, as you know, we are almost 20% up year on year. So I think mixed fortunes globally for OEMs. The problem for us in South Africa is that we are starting to rely more and more heavily on exports. Manufacturers like Toyota, Volkswagen, General Motors, BMW export literally thousands of vehicles, and a large part of that export market is in fact in Europe. So if Europe is in the doldrums, as we all know, that could have severe implications for our local market, which those exports are great revenue contributors for the country, but also they provide economies of scale which actually help to keep the cost of cars in South Africa quite low. Future vehicle sales, very, very difficult to predict because I think there are a number of factors that could come into play next year that could really adversely affect that. The first thing, of course, as I mentioned, the biggest driver right now is the fact that you can buy a car cheaper than what you did 4 years ago. So that could change if interest rates start to increase, if the rand continues to weaken as it has done over the last few weeks. That means that vehicle CPI will start to move up, interest rates will start to move up, and that equation will start to change, and all of a sudden it'll be more expensive to buy a car. And I think that will put serious brakes on the demand from consumers. Likewise, corporate, we've seen corporates become a marketplace. We've seen evidence of corporates beginning to spend, beginning to replace some of their fleets, and that was missing in 2010 and in the early half of 2011. And again, global uncertainty. Corporates hate global uncertainty. They will only invest if they are reasonably certain that they will be able to use those assets productively. So I think there are a number of grey clouds that are hanging over 2012. So making a prediction very, very difficult. My view is that if we sell the same or even slightly higher, 2 or 3%, number of units that we sold in 2011, my take is that the industry will be more than happy with that.